What is up, everybody? My name is Mark. This is my co-host, Mo. And as you can tell, we have a special guest. Mo, would you like to do the introduction?
For sure. We have Afsha, and we're very excited to have her today because she will be talking about building wealth and her journey through her career. So I'm very excited. Welcome, Afsha.
Thanks for having me. I'm glad to be here.
Yeah, we're really excited.
Awesome.
Thank you for coming on.
All right. How was your weekend, Mark? We'll just wait a few minutes before people jump in.
My week has been full, man. My kids had the flu, so unfortunately, was spent the entire time with my kids, being sick, complaining, whining, making soup that they didn't want to eat, giving them vitamins they didn't want to take. Took my son to the ER. He got medication that he didn't want to take. So the usual kid stuff.
That's awesome.
But I'm just trying to make sure that they get healthy because we're leaving to Europe on Saturday. So I'm looking forward to it. Yes. How about you?
Well, I hear I'm the last person for the year. Go ahead, Mo.
No.
Ladies first. Ladies first.
Ladies first, yeah.
No, I was just commenting on, I hear I'm the last, interview of the year. So you're heading out to Europe after that.
Yes.
I can't complain. Watched the sunset in Malibu last night. Enjoying the weather in Cali right now. So it's been pretty great. But a lot of my colleagues and my team are dealing with about minus 25. So I try not to talk too much about it.
They're probably so jealous. I look at Afsha's story sometimes, I'm like, it's still raining in Vancouver. It's always raining here.
Yeah.
No, it's beautiful here in Florida. So I definitely. Zay was which was one of our guests. He was live this weekend, full-fledged coat, hat, everything. I was just making fun of him because I'm sitting here in Florida in warm weather. So pretty exciting. By the way, how do you like Cali? I
like it. I love it. I'm not as big of a fan of Los Angeles City like I thought. Don't hate me, everyone from LA. But I think Malibu is my spot. It's beautiful. It's right on the ocean. It's a lot more laid back. There's little shacks where you can just go get fresh fish. So just the lifestyle and how people are here is so different than how I grew up in the corporate world.
Yeah. Do you want to talk about it? Can you give us a little bit of a background of where you're from, like what you do in the financial space?
Yeah, for sure. I mean, so I'm CEO of WealthFirst, which is basically a hub of all things building wealth. So everything from assets under management, for-fee planning, which is very different, and I'm sure we'll get into WealthFirst Insurance and then WealthFirst Academy. But a little bit about me. So I'm Canadian, so fellow Canadian Mo, hey, what's up? I started when I was 23 years old in the wealth management industry. I worked at a bank, and then I had my own practice for just under 10 years, 8.5, I think it was. And I just recently actually went independent and expanded into those different areas. So I kind of got started building out a practice, bringing on clients, teaching them about, investing and all the different areas that involve wealth management, and then recently just jumped ship.
Oh, thank you for that rundown. So Mo, over to you, buddy.
So, I've spoken to a lot of people in this industry, and our goal is always to bring people that are professional and they know what they're doing. They have all the certification. And my initial conversations with Afsha were so different because most of the people that I talk to are either getting into trading or they're financial advisors, and they're basically helping people out. But my conversation with Afsha was more wholesome, like, it's all about building wealth, and there's more than one avenue. It's not just options trading. It's not just stocks. There's so much more to it. And she has a very different perspective. So I want people to understand her approach. So how do you say that you separate yourself from a typical financial advisor? Like, and when I talk to you, you actually talk like a wealth strategist. So what does that include? How does that happen?
I think the number one thing is removing bias when you're talking about wealth, right? So a lot of people, when you're sitting down with someone, they're talking about what they sell. That's the truth of it, right? So if you're meeting with someone, they're going to pitch their course. If you're meeting with an advisor, they're going to pitch the proprietary funds that they have at their company. The thing that I wanted to provide, and the reason I went independent and expanded my team, is so that we could provide all areas. So it's true, unbiased advice. If someone wants to invest in real estate and that's just their thing, we want to be able to help them with that, right? If they want to invest in the stock market, or they just want financial planning, but they want to invest on their own, we want to be able to service that without making them feel like they can't do it by themselves, and that they should just stick to us and do whatever we propose. I think the number one thing that's missing in wealth when it comes to building is people are just, they stick to what they know. And when it comes to the professionals, they only sell what they can. They only talk about what they can sell. In our area, we want to really help you and say, okay, like if we just took everything you were doing right now, where would you be in 10 years? What type of access does this provide you? How can you use this? What does passive income look like for you? What types of assets do you want to own, right? And then like, where does that get you? And then if we provide different strategies, how is that actually going to enhance your net worth, right? Not just invest in this because I say so. I think that would be the major difference.
And how do you say that you involve yourself when it comes to the wealth creation for an individual?
Well, because we have many different arms, where I would say I involve myself is I really want to sit down and understand an individual's goals. I think my greatest asset is to be able to connect with people and make them feel heard, and then find the right branch under WealthFirst that can help them. So I want to work with clients who have $50 million net worths and help them expand beyond that, or help them get out, right? You built this company and now you don't know how to get out. So we build succession plans. But I also want to help the person who has $1,000 to their name and is looking to start out and wants, again, unbiased advice on where to dabble in and how to grow. And I really want to help people redefine risk, right? What does taking risk mean to you? Is it just volatility, right? A lot of people think if they invest, they're going to lose it all, or you only have to take certain amounts of risk to grow. And I really want to spend time on that conversation of what risk means to you in order to help you become a better investor.
One of the things that I've noticed in the culture in Wall Street is like, just give us the money, we'll manage it for you. And then they'll start using complicated words. So someone who has no clue, who's starting out, if someone comes to you, they say, hey, I want to learn, I want to manage my own money. Are you able to help them as well?
Yeah, absolutely. They could book a consult and they would say, hey, this is what I've done so far. We do free portfolio reviews without you having to actually move it over to us. So one of the things that I wasn't able to do before, and it's prominent across the industry, is that I'm going to tell you that I want to help you build a plan, but then you have to move your assets over to me. And I wanted to remove that option, and I wanted to provide for-fee planning. So someone can book a consult, they could be invested in real estate and want to do their own trading, and we can still help you, actually give you a roadmap as to where that's going to get you and help you out, versus, hey, now you have to move your money. And that's a really common across the industry, that, you know, any bank you walk into, first of all, you have to have $1 million plus in investable assets. And then you get paired with a for-fee planner. And the problem, I was talking to you about this earlier, is that you get paid based on investments, assets under management, but you're providing a service for fee planning. You're saying, I'm going to build your retirement plan, but you're going to pay me by moving over $1 million. And I think there's a conflict of interest in that. You should be charging for the service that you're offering.
And most of the time, they're not actually actively managing the account either. It's just sitting, the money's just sitting there.
Yeah. So that's one of my biggest, I mean, you know, that's the biggest issue as to why we left. We were doing really, really well. We were at my team, you know, we were managing 45 million assets under management. We didn't have to move. But when we saw that there's this concept of active management being delivered on a platter, right? And I'd sit down with compliance and leadership teams and say, hey, look, this is the exact same asset allocation. These are the same companies, but we can do it at half the cost. Why are we not investing in this? Or, hey, traditionally this asset class performed this way and it was positioned in this way, but it's not doing that. Why are we not getting out? And it was crickets. So, you know, I really started to do a deep dive into, are we actively managing this, or are we just pretending that we are and saying that there's active management, but really we're selling buy and hold forever?
So that's like kind of the issue between managers who are like passive and active managers, right? Kind of like ARKK, which is more of a active manager.
Yeah. I mean, yeah, how did that do, right?
Yeah, they didn't do very, very well.
That's bringing ARC.
Yeah, because
Yeah.
I noticed a difference when, for example, like if you go to USA or E-Trade that offer, portfolio management services, right? These are like big banks. You're not really talking to someone who's going to actively manage your account versus like my financial advisor. He actively manages my account. And how do you differentiate the difference? Like, how do you know if you're getting an actively managed account manager or a passive?
Right. That's a really good question. I mean, I think that the difference is, are you getting a call from your advisor when there's a change in the market, right? When we get news for inflation or interest rates change, or we're in a bear market, one of the biggest ones, it's like, how did your portfolio change? We sit down with people. We just did a $500,000 consult this morning, and, we asked, what was the strategy given to you 6 months ago? What were you told to do differently this year? We're in a very different time this year than last year. And there was no answer. There was no change. It was just everywhere is losing, and we just got to stay put. So that's how you would know, okay, there's not really much active management going on. But if you're being told, oh, everywhere, there's loss everywhere, I mean, we all know that's not true, right? I'm sure anyone that's even joining this call can say, yes, we know there's different areas that have done really well this year. I'm sure you guys have been teaching that all year, the different sectors that have done really well. So if you're not hearing that from your advisor, then you're not being actively managed. You're being sold the buy and hold strategy.
You have a very different view of this. And I'm always curious, how did you kind of like, because I know, like we talked about, mainstream is just buy and hold, and they're just putting your money passively and just keep doing dollar cost average. And I work with a lot of financial advisors who are either trying to learn options trading or trying to teach their clients on hedging. So I see that. And my question is, and I'm not trying to offend any financial advisor, my question is, how are you giving people advice when you're not there yet? However, when I talk to you, you're very well versed in different categories. Like, was this something that you kind of was like, I want to do something different? Or did you have a different style of mentorship and training given to you?
Absolutely no mentorship given to me. The industry is full of it. In fact, if you're different and you're trying to actively research changes, it's frowned upon actually to do that. It's like, why do you want to buy these other funds or these different investments? You should just stick to what we're telling you to. So the reason I had to get out is because it felt like there was a shackle on my ankle every time I researched and explored more. So I think it worked backwards than what they wanted, right? It ended up making me leave, and it ended up making me pursue what other options are out there. I think I deal with a lot of clients in early retirement or in retirement, and I see how detrimental the only buy and hold strategy can be. I see that it takes forever for recovery, right? There's still people that could say that they're recovering from '08. And so it doesn't sit right with me. For me, I constantly talk about and look at what the next 5 and 10 years look like, even for my practice. And I think that people who just keep doing the status quo and don't look for what else is out there, they're really going to drown. And I didn't want that to be me. I knew that I needed to build a company that could provide a service no matter what type of client was sitting in front of me.
So I'll say this, maybe Mark agrees, maybe Mark disagrees, but you're probably the only person that is in this line of work that has said that buy and hold is not always that's something that works, which is what we're seeing now. A lot of funds that were like buy and hold are so down. And what they're doing now, and I'll bring ARC, they're blaming the Fed for everything, for dollar cost averaging coin at 600. So Mark, do you agree with this? Like, we usually see people saying buy and hold.
I agree 100% because I just started like taking this serious maybe 2 years ago, and that's what I was taught, right? Everyone's always like, you buy and hold and you'll be rich when you retire. It's kind of like the Dave Ramsey concept somewhat. Not saying that what he's saying doesn't work, but just a lot of people are kind of telling you just buy this asset and hold it. And then, for example, with Facebook, you bought in 2017, you're right back, or maybe even lower now. So I have drastically change my mindset and the way I invest now is that I will start taking profit when it's needed. And I noticed that with my financial advisor, he started to actually go cash last year around October, November. And the way he was explaining it is when people are really greedy, good financial advisors need to start looking like, wait a second, we're really high up there. We might need to start shaving off a profit and putting stuff to the side just in case. And if we leave some money on the table, that's okay. It's better than just holding it while everything's going down. So you are one of the rare breeds out there that's saying, don't just buy and hold forever.
Yeah. I mean, it's incredible. Like, we couldn't do it for so long, right? And I love that your financial advisor actually called you and told you to hold cash positions. That's another thing, is that a lot of firms, they don't really allow you to hold cash. Like, that's ridiculous, right? So you're taking profits and you're just forced to reinvest it again, whether or not there's an opportunity. I mean, this year all week we've been making calls to clients and just saying, hey, like, Christmas came early this year. We're going to take some profits, right? Like, our silver positions are up 20% right now. So we're taking profits. That's the name of the game. It's not that buy and hold doesn't work. I want to be really clear, right? There was a certain point in time where if you held Microsoft, for example, buy and hold worked, right? You didn't need to get out. But if you look at the energy or oil sector in Canada, you absolutely, if you invested in the beginning of the year, you needed to get out around June. Or it just depends. Like, there are certain areas where buy and hold works. I think that buy and hold is talked about because it's hard to time the bottom. And I understand that. You can have your core holdings and you can have areas that you want to keep for the potential rebound so that you don't have to time it. But there are so many areas that taking profits is how you beat the market. And I think that that's missing. It's not or, it's and.
Yeah, quick question though. How do you feel about, does that also apply to like ETFs and the indexes like SPY or QQQ? Do you believe that as well?
Yes, absolutely. It depending on which sector you're in, there's lots of ETFs, like, for example, something like semiconductors. If we purchase ETFs, you absolutely need to take profits when it makes sense. You need to get in when it makes sense and get out when it makes sense. It's not just for stocks, it's for ETFs, even mutual funds. It just depends on which sector you're in. If it's not like this total and complete growth portfolio. And that's another thing, right? The other thing that's taught is not just buy and hold, it's diversification. If you think about it, diversification worked against you this year. Why are we holding international equity? Or why are we holding fixed income as an asset class this year? The amount of people, retirees, or the amount of people who think that they're conservative investors that are in a fixed income asset class, like 60% of their portfolio or 40% of their portfolio, like if you're in a balanced fund, for example, 40% of their portfolio is in fixed income, and that's doing like minus 14. So we talk about risk, but then and then we don't actually help people define what that means. And an asset class that's supposed to be conservative is being sold as conservative, but really it's doing what an aggressive portfolio would do, right? A high risk portfolio would do. The standard deviation, the math isn't working out, and people are not getting out when they're supposed to. So diversification would have been another thing that I see like conventional advisors doing, where they're saying, yeah, we're just you're an aggressive investor, we're gonna be in a growth portfolio, and we're gonna hold X amount in Canadian equity, X amount in US equity, and this much international, and 3% in emerging markets. Like, just it doesn't make any sense.
So do you think, and we'll get to the next question, which is what are the red flags of the industry? I think one of them is this. I think a lot of times people say buy and hold because, again, it's less work for them, less research, less training, because the dollar cost average has worked for the last 50 years. It's going to work out for you.
Exactly. I mean, like, one of the red flags I definitely see, like we talked about a hedge in the beginning, right? So fixed income as an asset class, traditionally in the conventional world, that's what's used as a hedge. It's supposed to keep its value, and it's not supposed to drop. That's what's supposed to happen when equities are down. And that's how it's sold, and that's how we're taught to sell it, right? But this year, I think anyone that's purchased that knows that that is not how it's supposed to typically, it's not acting the way that it typically does. And so you need an advisor, or if you're doing it yourself, you need to look for alternatives. What's an additional thing? You need to have long and short positions. You need to have alternative investments that are uncorrelated to the markets. Like, there's areas that are doing really well. Look at commodities, right? Those can be different areas that can help you have a hedge in your portfolio, but you wouldn't want to hold fixed income traditionally. But if you look at any bank or any major institution, they have millions invested in fixed income still. And no one can answer as to why they haven't taken it out.
Do you think it's also, like, I think you mentioned earlier on too, like, they don't want to go cash because is that somewhere tied to their compensation?
Yes, it is. But also, yeah, some people, I'm not even, honestly, I have got into it with different leadership teams. I'm like, why are we not holding cash? You will have compliance email you and ask you why you're holding cash. Like it's almost, they don't understand investing. They say there's these guidelines, there's regulatory bodies, but if you actually broke it down, regulatory bodies do not stop you from holding cash. And that was one of my biggest issues is like, why are we not holding this for an opportunity? So yes, I think it's to do with compensation. I mean, but not to throw every advisor under the bus. I think it's the industry that's the issue. It's not encouraged and it's not taught. Like when you start as an advisor, you're not really taught, okay, you know what, take profits and hold cash. The whole name of the game is dollar cost average every single month. And this is how you'll do when you grow your book. And the goal is to bring more people into your practice instead of actually focusing on the growth. They're like, let the portfolio managers do it. You don't worry about it. Like that's, so I think it's a problem in the industry as a whole, not necessarily every individual advisor.
When did your mindset change on this? Because like you said, you were taught first that, dollar cost averaging. At what
Yeah.
point, at what point in your career did a light bulb go off and you were like, this is not really working?
That's a good question. I would say, just to be transparent, that you start to notice it over time. I mean, we had such a great bull run, right? So anything you bought, essentially, you could make money. So it's hard to make a change in those moments, but you start to see the red flags. I think one for me was when I would just find an ETF at half the cost with the same company, with same holdings, right? I'm like, why are we recommending this when this is 0.07 and this is 1.8%, right? Just the difference in the fee and the same companies and the performance is better. And they didn't have an answer. So I'd say over time you start to see it. But the reason I pulled the trigger was specifically this year in a bear market. I was terrified that there was no changes to the portfolios. We still have, like, we could drop another 20, 30%, right? And the fact that we were not properly positioned to protect our clients' portfolio, that we were just recommending the same equity and fixed income holdings, that was what made us resign and jump ship. And what we have set up now is just, we want access to open marketplace, right? Whether we want to be able to recommend an investment that makes sense for clients, and we don't want to have to wait 3 to 5 years to recover. So I think you start to see signs as you work in the industry, but specifically it was the rebound potential that I wanted for my clients that made us actually move this year.
Do you feel like a lot of these red flags are quite obvious for people, or do you think because you're from the industry, you know the norms, and for the layman, they don't see it? Because I don't know, Mark, if you've been ever approached by a financial advisor, I have, and the conversation is usually, how can I grow your account? And one of the things I've learned over the last 6 years, it's my biggest question is, how do I protect my account? Like, I want to grow, but I also don't want to lose money. And no one really starts with that conversation. It's all about, I'll grow your account. And I'm like, okay, how do you protect me from my downside? And I think this is a question everyone asks now. So what are your thoughts on that?
You said exactly the question that we ask people. Like it's amazing. Like in the last 2 months, we've brought over 5 million. And the first question we've asked in those meetings is, I've asked, like, how are you protected if we continue to go down? If there's a recession looming, how are you protected? And there's no answer, right? So I don't think it's obvious. I really don't. The common conversation is everything is down right now. Aren't we just supposed to just leave it? If we move right now, aren't we going to crystallize our losses? Because that's what's been taught. So to answer your question, it's not common. I think what we did took a lot of guts. And even talking about this, and calling out the industry is very rare. And I know what I'm doing, but I have to do it because there's too many people's portfolios suffering, and no one's going to get that money back for them. Like, there's no accountability. And so, we have to do something about it, right? I'm on this podcast, I'm in meetings, I'm teaching online. I started WealthFirst Academy for this reason, right? The information we put out this year is going to be different than next year. I think you need to follow along with what's happening in the markets, or you're just going to get left out. If you keep using the same strategy, no one cares what happened 10 years ago. I'm sorry, but what happened 10 years ago in the market is not what's happening now. And if your advisor is showing you 10-year historical performance in order to pitch a investment that works now, you're probably at a loss. So
We're seeing that in our industry too. A lot of people are saying that they grew their account with options trading in 2020. And
yeah.
back then, like, you could have bought anything and just trade and bought time and you'd be up, I'm
Mhm.
saying 500 to 1,000%. But now, like, trading is just, like,
It's
I'm telling
rough.
you, 90% of the people didn't even keep it. Like, they couldn't hold it. Like, they made that much money. And most of my conversation is, hey man, I made 60K. I'm like, awesome, but I gave it all back. So that's usually majority of the people talking. So, like, personally, like, I would love, if I wanted to learn investment fundamental knowledge, I would go to a professional. So do you have something coming up in terms of courses or online that people could just kind of reach out to you for?
Yes, it's in the works right now. In the new year, it'll be launched and it'll start to come. Just basically, new courses will be released. My goal is, the thing about the finance industry or wealth management is there's so many areas you can learn, right? And I think what's important is to just have a roadmap. So, for example, if someone's like, I want to learn how to buy an investment property, the idea and what we're building is that from start to finish, we take you through the whole process, and you shouldn't have to leave the WealthFirst Academy course in order to learn, right? So it's a beginner. If you have this much money and you want to learn about the market, you want to learn about risk, and you want to just anything that's out there, we want to basically create a roadmap for you so that you can take it. And by the end, you can actually feel like you graduated and learned. And I'm basically going to put out everything that I know. Um, and what's unique about the finance industry also is that I'm constantly doing continuing education because there's so much more to always learn. I don't know everything. And so I bring on other experts, right? Like we have CFP professionals, we have IROC licensed, we have a portfolio manager. And so we give market updates, but my goal is for someone to be able to come and land on our page and say, you know what, I didn't know how to do this. I didn't even know where to get started. And I bought this and was able to get to the end of the process using the WealthFirst course.
Okay. Mark, do you have any questions? I think I've covered all
Yes,
of mine.
I actually do. Since you're in this space and you've been doing this for several years, I know you've noticed that there's been a massive boom since 2020 of financial experts online, right?
Mm-hmm.
And do you ever watch them and kind of think to yourself, what's going on here? Like, why are people listening to these individuals?
Yeah, it's pretty cringe. Um, it's it's so hard to say, like, that's what makes it so tough. Okay, so I love social media. I think the online access gives it, there's so much information, but there's a lot of dangers in that, right? That anyone can go online and just say, yeah, this is what you should buy, and here's my course, and pay me this much. But there's no accountability. I also don't really like people who just pitch returns, like, oh, I made 30%. Okay, 30% in what time frame, on what asset, how much money, right? So I see a lot of that. I would just caution people that are looking for information to not just jump on like the lowest hanging fruit, right? Which is like just buying something based on like an advisor or someone pitching that, someone claiming that they're an advisor. Obviously look into designations, look into how long they've been in the industry. Also look at whether or not they're willing to call out some of the issues, and then also ask what they're able to purchase, right? Because that will, if that, if what they're able to buy is just the specific thing that they're recommending to you, well, now you know that their advice is biased. So as much as I love the online space, I think there is a lot of information, and in order for you to navigate what's true and what's not, like, you got to stop buying a ticker because you saw it on your timeline, or purchasing a course because they promised a certain ROI. I think it's really important to sit with them and ask them the real questions, the hard ones, and see if they're willing to give you information and knowledge on the things you're asking and not just what they're selling.
Good answer. And I'm sure as a female in this space, right? Because this is a predominantly space with a lot of men, right, who run into this financial space. What
Mm-hmm.
challenges did you have to deal with to create your own and wealth and get like to the level that you're at? Because I'm sure it was probably somewhat difficult, right? Because that's kind of like what Kathy Wood, that was kind of her the reason why she was like the underdog, right? Everyone's always like, oh, she's in a space that's predominantly male driven and nobody really respects her. And then she skyrocketed in 2020. Everyone thought she was a genius and now everyone's making fun of her again. So what challenges did you have to overcome while you were getting into the space and then growing all the way to $45 million under assets under management to starting your own?
How much time do we have?
We still got, I think you got 15 more minutes.
I mean, I think like there's so much I could say about that question. I really appreciate the question. I mean, like when I started, I was 23 and I was the only female minority in my office that opened her own practice. So that alone was something I had to navigate. People will not take you seriously. People will think that you're the assistant that's showing up. People are used to a very different demographic showing up as an advisor. So when you do a phone call or you show up at the door or you're doing a presentation, first thing people are looking at is just like, okay, your age, and obviously that it's male dominated, so they don't see that. But I would say, instead of talking about all the different areas that I had to navigate that were tough because I was a woman, I actually want to talk about how many things, how much success that I was able to get because I'm different. I think that, you know, if I focused on how many people weren't expecting to see someone that looked like me, someone that's a woman in this industry, then I would probably not have the success that I had. But instead, what I started doing is like, okay, what's missing in this industry? Like, you did this, I can do it, but how do I do this better? What is missing? I think the advantage I had was that I just worked with a lot of Caucasian male advisors in their 50s. And so I was really quickly able to pick up on what I needed to change and what I needed to do differently. No disrespect to them, but I think it ended up giving me an advantage.
Got you. Yeah, because the reason why I was asking, because we do have some female viewers, and I know a lot of female women who are into this space and who want to learn about finances. Is there any recommendation you have where they can achieve what you have achieved? Like anything that you feel like maybe some tips that you could give them?
Yeah, absolutely. So the thing that makes you different that you're self-conscious about, or you think, you know, people are watching, like, let that be the thing that makes you stand out. Let that be the reason that you were able to get success. Like, really dive into what makes you different. I think authenticity, especially when you're in this industry, and empathy are something that those are two things that are laughed at. It's really easy to lose it. And if you bring those things to the table as a woman, continue with that path. Yeah, empathy is an underrated value to carry. And I think it's what's going to make you go further. My highest net worth clients, the ultra high net worth that are in the $15 to $20 million range, that's high net worth for myself. The thing that they're going to tell you that they love about working with me is that I actually listen to them and I connect with them. It's not that I did this crazy amount of ROI. It's not that I called them this many times. It's how I connected with them. And so just use what makes you different as your power. To any of the women that are listening to this, just you can really get drowned out, and you will feel like you have to do twice the work to even get recognized. But honestly, the things that you build as a result, like the stamina and the grit that you build through that process, you're going to stand out and that's going to be a good thing for you.
I love it because it clearly worked for you. And I'm sure, like, especially right now in this culture that we're in, right? It's all about the hustle culture, right? How did you manage your life work balance overall? Like, do you still feel like you have to work 12, 14 hours a day to really be successful? Because that's what it seems like nowadays, right? No, don't sleep, just work out, study, drink energy drinks, you know, meditate, listen to Gary V. Yeah. And then, you know, study more and exit. Yeah. It's just go, go, go. Do you feel like you're
cold shower? That's it.
Yep.
That's
Are
the
you
only
still
way to make it and be successful?
Yep. And how do you feel about that? Are you still doing that? Or did you ever do that? Or do you think that's just a myth? Or do you think it's just kind of a cool thing to say online to get people motivated?
I am like absolutely anti-hustle culture. I used to be all about it. It was definitely something that I thought was great. Like, be the first one to turn the lights on and last one to turn the lights off. And, you know, that was obviously how I built some of it. But I realized over time that you will just crash at some point. It'll work for a little while. And that's why people will say like hard work and grit is what you need, but you need to balance. The one thing that I constantly talk about is like humans, we've evolved we've evolved through struggle, right? So we're able to handle a lot, but the problem is when it's chronic. If you don't take pauses and you don't stop, is when it becomes an issue. You can put yourself through a lot. You can work at high intensity, but you need to take breaks. Like for myself right now, I'm in California. When I'm done this, I'm going to go to the beach. That is not something that's necessarily encouraged. And I definitely I really try not to, I guess, encourage hustle culture. I'm doing a lot. I work very hard, but I've learned to take breaks. And it's not always easy. Sometimes I get reminded by people who love me that you need to stop and give yourself some time. There are different things like cold shower and meditation and things like that that you can do. But I actually think that when I do get back to work and I take a break, I'm able to work that much more efficiently. The other thing that I would say is if you're building a business, don't underestimate operational efficiency. So if you want to scale, right, you can't be the person that's doing everything, and you need to create a system. You need to develop your SOP. You need to develop a process so that if you're hiring people or you're bringing more people on, you want to be able to navigate it. There's an entire system that's built that explains it. It can't just be in your head. And I find that that's a big struggle for a lot of business owners, is that everything that they do comes from their talent, but what's in their head is not on a piece of paper or a manual that can be replicated by other people.
Wow, that's deep. Thank you so much. I mean, do you have anything else, Mo?
No, that was amazing. Thank you so much for coming.
Yes. Please tell people where they can find you, though. Oh, go ahead. Sorry, go ahead.
Yeah, that's literally what I was going to ask.
Oh, yeah. Please tell people where they can find you.
Yeah, absolutely. Well, my personal page is Afsha Official, so AFSHAA Official. And then if you want to come learn and join the hub, you can join WealthFirst Inc. is the Instagram page. Our website is wealthfirst.ca. Reach out and send us a DM. We're always encouraging people to start conversations. Book a consult with us. We have like a 30-minute no obligation call. If you have any questions and you want some pinpointers of how you can work with us, you can definitely do that.
Love it.
Awesome. And we'll be posting the link on the YouTube link as well, if you didn't get the name, so don't worry about that.
Perfect. Thank you.
Mark, do you want to continue with the FOMC? And I think, Afsha, thank you so much for coming in. We really appreciate your time, and it was amazing learning from you.
It absolutely was. Thank you so much. It was a pleasure.
Thanks for having me, guys.
Hopefully we can have you one day again. So appreciate it.
Yeah, it'll be absolutely okay. Enjoy Europe.
Thank you. Bye. That was good. That was really good, Mo.
All right, Mark.
Good guest. Yeah. Go ahead. Do your FOMC. Yeah, she was awesome. She was awesome. Hopefully you guys learned a lot there. Please, for sure, make sure you follow her. That was great. So this is not some fake guru. She's real deal, amazing. So Mo, go ahead, cover the FOMC, and then we're gonna close it out, ladies and gentlemen. And again, thank you guys for tuning in. I really appreciate it. Make sure you guys subscribe, please, and definitely share this episode. I would really love it if you guys can share this episode. That's my Christmas wish. How about that? That's me, Mo's Christmas wish. Please subscribe, like, and share this with as many people as you know, because I think that information was very different than what you hear on the mainstream. The difference is you can literally verify this person. So,
Mark, how many YouTubes we watched, how many podcasts we watched, I haven't seen a guest like her come in and just be as real and authentic. And trust me, our first phone call was basically, my question to her was, what do you think about buy and hold? And I was like, are you sure? She's like, yeah, I don't think it works for every single asset class, which is what she said here. So we were actually going to cut this video today just right here, but me and Mark decided that tomorrow is FOMC and it's not fair. So this is our Christmas present to you guys. So I'll start with this. The biggest problem that I'm seeing with a lot of new traders is they're trying to copy a lot of people without realizing how much money they have and if they're telling the truth or not. So simple example, I've been working on straddle. Mark's been working on buying and selling calls and spreads, right? So we've been paper trading and testing different strategy. One of the strategy was, let's say, give or take, you have 10 grand and you go 5K calls, 5K puts, build a straddle or a strangle, doesn't matter. Meaning you're covered both ways. how much money would you make? Mark put the numbers in. He has a very good platform, E-Trade, and the chances of that working, making money, was 5%. So right away, the numbers are telling me that I don't want to do that. 5% to risk 10 grand or 1,000 or 500 is not worth it. That's a very low probability, right? So I'm not going to touch it. This morning, the straddle did good. It gave a return of 100%. So you might be like, well, that's amazing. Let me do it next time. Well, it's not amazing. First of all, the numbers that we saw this morning were extreme. So we jumped 2.25% right off the bat. And the risk and reward ratio for the straddle was 1-on-1, meaning if it didn't work, you would have lost the entire $500. If it did work, you would have made $500. So what a lot of people do, and you guys might not realize, is Mark can go open 2 separate accounts, buy calls on one, buy puts on one. One will work, Mark will take and post the screenshot of what worked and never talk about what didn't work. I'm not saying that's what people are doing. What I'm trying to make you understand is if I took 5K, which I promise you isn't a lot of money for a lot of people, just 5K, and just gambled it on one call or put this morning and would have opened to 25K. That is not trading, that is gambling. And a lot of people do that. Sometimes people do it for subscription. Most of the time it's for subscription, telling you they're mature traders, they know better. Any good trader that I know that I seek mentorship from, they either traded futures or they went in cash, because you don't want to go in this environment non-biased. I just wanted to make sure that I reset the mindset of people that are watching, thinking that they missed out on the move. After the market opened, we literally tried a put, didn't work out, waited for 40-40 to break. 40-40 was, let me just share screen. Mark, go ahead, add if you need to. I'm just going to take a second.
This morning I immediately saw, because you guys know I also trade futures. Granted, I haven't done it in a while, in the past couple months, but I still pay attention to the future market. And after the numbers came in at 8:30, the CPI numbers, the market completely ripped. And it went way too high, in my opinion. I think we were at like almost 3% on the S&P 500. We were definitely over 3% on NASDAQ. So I already knew, I had a bias. My bias simply was like, we already did the run up pre-market. It's going to create FOMO for a lot of people who are probably going to get in calls, and then we're going to sell off. And that's in fact what ended up happening. It ran up. You have to pay attention sometimes to the pre-market. When it runs up insanely like that, that's not normal. Don't expect it. Because if you ran up 3%, do you really think it's going to go to 8% that day? I think it was a Stanley Morgan or it was Goldman Sachs, one or the other. They were saying that there was a potential chance of an 8% move up if the CPI numbers came in at 6.9, which it did not. It was kind of where people were expecting. So yeah, that run up was really insane. And if you weren't doing futures, I believe if you got into calls, you most likely probably got burned if you didn't take profit immediately.
Yeah, so JPM had this really nice chart. I could share it later, but basically it said if the numbers are this is the return. So their number for 7.1 was 4.5%. So I thought we might go up higher because there's a lot of puts that will get squeezed, right? So we might go higher, but that's not what happened. All I did was sharing my chart. I waited for us to get below 40-40, which was the 200 moving average, 40-35 now, and I got in puts. And believe me, they didn't do that much. They did 100%. And you might think 100% is a lot. It's not for SPX if you get the direction right. It's because the IV was too inflated. And I highlighted Malik's quote that one of my rules is don't mask gambling as trading. That's the conversation I was having with Mark. This is pretty much like Tesla has earnings tomorrow. Let me put in bet on one side. Anyone saying that they know what would happen, they don't know what they're talking about, because a lot of these numbers can be manipulated in different ways. I agree that inflation is cooling down, and that's good. But let me ask you this. Why do you think we sold off today? There's a simple reason. If you understand what a lag and a lead measure is, this is exactly what it is. These CPI numbers, they're lag measure. They're for November. Market is forward looking. The reason why we jumped up is because market was pricing that they overreacted with selling. But once it got up there, people that have been holding stocks, they were selling. Apple went from 150 to 145. People are actually selling Apple stocks. They're trying to get out of it. AMD went all the way to 75. closed around 70-ish. This is what's happening, right? So FOMC is a bigger event than CPI. Why? Because it's a lead measure. The Fed will tell you exactly what they're doing, and that's how the market will react. The market follows the Fed, not CPI. CPI is a lag measure. That's what people need to understand. Now, we don't know what Powell's going to say. I have zero clue because this guy went from super bearish to not bearish at all, casually talking about inflation. So we don't know what happens tomorrow. The number that you need to watch out, there's two numbers that you need to watch out: the 200 moving average and the 100 moving average. There's two reasons for that. One is their key support and resistance, and two is this is what the funds buy and sell at. If we get under 40.35, this level, let me get a line here. 40.35, the next level we have is 39.31. If we lose that level, there's a high chance that we get to 39.31, and most likely we get to 3,800 by Friday. However, there isn't much upside. Upside, we cap at 41.50. Max for me is 4,200. The simple reason for that is the macro is simply looking ugly. So for me, if we go up, I'm just going to start adding puts for March. That's what I'll do. The second point that I want to mention that is very key, there's a trend that I've seen in the last 8 weeks. If we are going down tomorrow, so if we open and start selling off 30 minutes before the meeting, we'll have a counter move. So if we're going up, we'll go down. If we're going up, we're going to go down. The reason for that is people are covering before Powell talks. The second thing that you need to know is the first move is always the wrong one. And we've seen that time and time again. So usually the minutes come out and then Powell's talking. Usually the minutes come out, and if it's up and when Powell starts talking and the questions come, we go down. And usually that's because people are taking profits because we don't know what Powell's going to answer those questions. Overall, I'd be very cautious if you think there's a Santa rally coming and we'll hit 4,500. That is the dream that they're selling. The funds are selling. Tom Lee is selling that. There's a guy, I forgot, Mark posted or something about Tesla going to 200, 300. Instagram actually flagged it as false information. I don't know why. So I got a alert from them. It's crazy. I'll send you the screenshot. But
That's weird.
There isn't much upside. The biggest gift that me and Mark can give you is know this, that the 10 of the top people, last 50-year performance by these funds, they're saying that Q1 will be the start of a recession and we will have a new low in the last 2 years within Q1. So March for me works perfect for long-term puts. If you're like, I don't got that kind of money, make sure you're skilled in day trading and weeklies. If you're not, you're going to lose a lot of money even with things going your direction this week because you also have quad witching, which means contracts are rolling over. So things might not matter in terms of direction. The IV on stuff is so high that you might not make money. So quickly, and then Mark, I'm going to turn it to you. This was my spread calculation. I'll share with you guys. The return to risk reward for a normal day. Let me see if I can. Give me 1 second. I want to undo this. See if it works. Sorry. Yeah, it's not. The Excel sheet, I think I messed up. So if the volatility wasn't that high as it was today, the return to risk ratio was 1 to 5 on those straddle. But because the IV was so high, the return to risk ratio on a downside was 3%, and on upside it was 25% on a straddle, which is like the worst ratio you can get. But on to you, Mark, if you have anything to add.
Yeah, no, also my recommendation, again, is not financial advice, but I suggest a lot of people, especially if you're brand new, start learning the basics of like vertical spreads, cover calls, the less risky plays, instead of just going a simple straight up direction of puts and calls. Today, like we were talking about, I've been testing a lot of these vertical bear calls. If you're not familiar with it, please look it up. And when we reached 410 on SPY, I end up actually doing one, paper trading. So I'm gonna be very transparent. It was paper trading because I'm practicing right now for the next month to see if I'm understanding it properly and if I'm executing it properly. And I actually end up hitting 100% by the end of the day. And I think my return, I sent it to you, right, Mo? I think
Yeah.
my return at
I have
that
it.
day was, I have it here. Yeah, $675 off of 5 contracts. So the risk was, I think they said the probability, the good thing about E-Trade, they show you the probability of the plays. They're not 100% accurate, because yesterday it said I was 78% probability of actually winning the trade, and I end up losing that trade. But I've done it. I'm 4-1 right now. 4 wins, 1 loss, and I'm relatively up in this paper account so far. But just learn different strategies under different environments. A lot of us were just taught simple, straight up puts, calls, leaps, weeklies, monthlies, and that's it. There's a lot more to it, a lot less riskier plays. That's literally what I've been doing for the past 6 months, because I don't have the time anymore in the morning to trade like I used to. And I can tell you, I haven't lost any money. So it's been relatively good. It's baby money, but it's an accumulation of just the compound effect, slowly building. I did it on Carvana. People thought I was crazy by buying Carvana, but I had a whole process and the reason why I did it. But I'm up at almost, if I can roll this one more week, the shares that I bought are completely free at this point. So I've been doing really well this past week and a half on Carvana. But that was a crap stock that I just took advantage of volatility, human behavior, and the fact that it sold off 48% in a single day. I'm just suggesting that people start, if you just learn puts and calls, start from the beginning, reset, erase your memory. There's a new year coming up. Have a plan and learn other strategies that may work better in bear market, in a bull market, in a flat market. Try to know all the different ways you can make money, but practice first.
And should we do a little bit of a show off or no? I want to talk about the CCL play.
Yes, talk about the CCL play. And while you're pulling that up, it did hit home. I'm not gonna lie, I was a little emotional today on Twitter. And the reason why is I'm getting a bunch of DMs now, right? They're like, man, you called it with the 150 Tesla. And we're not a channel that likes to brag all the time. And maybe that's the reason why we don't have a bunch of subscribers. Maybe we just need to do more of bragging and like, this is what we called out or whatnot. But when Tesla was at 300 on this channel, we literally said that it's going to drop significantly. And people used to call us idiots. They would say, you don't know what you're talking about. We called, I think 205 is what you called first, Mo, right? I think you called 205. I think I said 250 first. I was like, 250 doesn't hold, it's going to go 205. You were just saying 205. And it ended up going from 300 to 205. Once it hit there, we saw that it was not holding properly. And the next level was what? 150. I said 165. That was 188 was my demand. I did buy a share there, and then 165 was a major support. It broke and went to the 150s like we called. And everyone kept saying and making fun of us on Twitter, like, you guys don't know what you're talking about. You obviously don't understand Tesla. But macros and micros and the behavior of the CEO and the environment that we're in does matter. No matter how good the company is, no matter how profitable they are, their PE ratios still matter. They still matter. So yeah, we called it 6 months ago. So if you're a bag holder with Tesla, I wish you had listened. You could have taken profit and probably get in sometime sooner.
Well, I will tell you this. I think we get to 65 probably before Q1 end. And
oh, you're going real aggressive.
Yeah, I think people might believe it now, but you have to understand position bias is very prevalent. I'd say 90% of people have position bias. And you can say that with simple things, like if you own something and someone comments negatively about it, a lot of people will get offended because they feel like it's a personal attack. And so when you own a stock, when people make a comment, you feel like someone's calling you stupid. Someone isn't calling you stupid. I'll tell you this. I bought an Uber stock, and when COVID happened, probably a week before, I sold it coincidentally. And I thought I was such a smart ass. And after that, the stock went up 100%. And right. So what I'm trying to tell you is we all make mistakes, but you should learn from other people's mistakes because we've made them. And now we're trying to help people get better at it. And this show by any means isn't a promotion for anything else. This is a free show. We don't charge for anything. There's no paywall. We bring amazing guests. We had Mark Monroe before this, and then we've got
We had
more people
Q,
coming in.
we had
Q,
JT
yeah.
Pocket Watcher,
We
we
had
had a
Zay,
lot
we
of
had
people.
Kim.
Zay, yeah.
Yeah. We bring people that actually care and they're authentic. They'll call you out, they'll call us out, and that's what we want to do. But I think there's a big problem with people emotionally, and it's largely due to how they handle money and life, and that leaks into trading. And until people fix that, no coach, no course will help them. And I'm starting to realize that more and more. And I had that question with Mark. I'm like, do we need to hire a psychologist and like just be like, instead of doing this? I'm serious, man. Money management is important, but the relationship most people have with money is more important. And that means a lot of people, and I don't know if you're that too, Mark, they will hold bigger losses than profits. Meaning, if they are up $50, they'll take profit, but if they're down 50, they won't cut losses. They'll hold it long.
Yeah, I
And
was doing that when you met me. I was doing that quite a bit. Remember?
yeah,
So things definitely shifted. So yeah, just make sure you guys have stuff set up for next year. You ready to pull it up, Mo, or whatever you got?
we don't.
This year?
So yeah, sure. Let me get the chart added. Sorry, I got into the conversation. One sec.
Yeah, and again, also just to make a few announcements. If you guys have been following us for a while, starting next year, so this is our last episode for the year. When we come back in January, we're only doing 2 episodes each month, every other week. We will announce the days. It will still probably be Tuesdays at 6:30 p.m. But the reason why we're doing that, our shows will go from 30 minutes to an hour, which we typically break anyways. We always go past 30 minutes. But we want to add more value, better content to educate you guys as well as, and girls, as well as just provide a lot more value in an hour span versus just trying to flood you with a little bit every single week.
So back to, I think, not I think, I know this, and you can go back. We've called about 9 plays, and not a single one actually did bad. We had one play that was a stock silver that was down, but I never got into it. So let's count out of 9, 8 did well because I want to be 100% authentic. This play I sold at 20% profit. This play did about 35% profit on CCL, and it's a March play. If you're still holding it, I don't know. But my goal is to keep sharing things that will have less stress. Might not be 1,000% because I'm not going to call anything like that, because that's going to need a lot of volatility management, which might not be a thing or a skill most people have. This isn't a lunchbox, Mark. This is the play that I'm looking at. I got in today and I took 20% profit and I got out. I'm looking at AMD 70 puts for March. They are at $660 right now. If the market rips, I'll be adding them. I think they can go to 20 by March, but you don't have to hold it that. I think 100% wouldn't be too much of an outreach for that play, because if we do get a big drop, it's at 70 right now. It could easily go to 55 before March. So that would take it to 20, which is 10 contracts, 6,600 to 20K around. So AMD March 70 put. If 71 breaks, we most likely heading down.
Yes, just to be clear, that doesn't mean jump into it tomorrow right away. Know your levels. Know your levels. So yeah, that's pretty much it. Everybody, I would like to say again, thank you guys so much for rocking with us for these past couple months. We really do appreciate it. If you don't celebrate Christmas or New Year's, have a great December. For everyone who does celebrate, Merry Christmas to you and a Happy New Year. And we'll see you next year, right, Mo?
Yep, we'll see you next year, guys.
Until then, take care.